We're always taught that investing is all about offense. It's about chasing the biggest returns, right? But what if I told you the real secret to winning, to long term success, has nothing to do with how much you make, but everything to do with how much you manage not to lose? Well, let's dive into that. Because mastering risk, that's what truly separates the pros from the crowd. So let me ask you a question, straight up. Those investments that you're counting on, the ones that are supposed to be your fortress when the markets get crazy, are they really as safe as you think? Or could they actually be a hidden trap? It's a huge question, and today we're going to put some of those popular beliefs right under the microscope. All right, first up, let's talk about what I like to call the safe haven illusion. This is that idea, that deep down belief that some assets are just guaranteed to protect you when everything else is falling apart. But you know what? We're not going to go on belief today. We are going to look at what the cold, hard data actually says. Now, we all know the playbook, right? The stock market starts to panic, and there's a stampede. Where does everyone run? Straight to assets like gold. And the thinking makes sense. It feels stable, it's a solid store of value, and it's supposed to be the perfect place to hide out. It feels timeless, almost obvious. But does it actually work when the pressure is really on? Okay, check this out. This is a real-world stress test, the COVID crash back in early 2020. This was pure financial panic. The S&P 500 just cratered, down 34%. But look at gold. It wasn't some shining hero. It actually fell 2%. And its correlation to stocks? 0.68. That means it was mostly moving with the market, not against it. And don't even get me started on Bitcoin, the so-called digital gold. It got crushed by almost 29%, with a jaw-dropping 0.9 correlation. The lesson here is absolutely brutal. In a real crisis, when people need cash, they sell whatever they can. And all those lifeboats get dragged down right along with the ship. And this quote just hits the nail on the head. There's no magic solution here, no silver bullet. The fundamental problem is that during a true panic, all those neat little correlations, they just go out the window. Everything starts moving together. Fear becomes the only thing that matters. So the big takeaway is, while some investments are less volatile, pretty much nothing is truly safe from a massive systemic shock. So this kind of forces us to ask a bigger question. If we can't perfectly protect ourselves from a big market crash, maybe we're focusing on the wrong thing entirely. Maybe real risk management means we need to expand our radar and think about risk in a way that goes far beyond just what the S&P 500 is doing day to day. Let me show you exactly what I mean with a classic story. On one side, you've got Blockbuster Video. On the other, Apple. I mean, both were absolute titans, right? But Blockbuster became a victim of a very specific and very deadly kind of risk. And it had nothing to do with the stock market crash. Nope. It was just erased by the future. That silent killer actually has a name. It's called obsolescence risk. And it's the danger that a company you've invested in, no matter how powerful it seems today, could have its entire business model just vaporized, wiped out by a new technology, or just a simple change in what customers want. See, this isn't market risk. This is company-specific risk. And believe me, it can be just as devastating as a 30% crash. And obsolescence, that's just one piece of a much, much bigger puzzle. I mean, if you own bonds, you've got credit risk, the simple chance a company just won't pay you back. And as 2020 taught all of us, there's event-driven risk, those huge shocks from pandemics or geopolitical events that nobody sees coming. The point is, risk isn't some single monster you can slay. It's multidimensional. It comes at you from all angles. So if risk is literally everywhere, and it comes in so many different forms, what's an investor supposed to do? I mean, hiding in cash isn't a real long-term plan. This is where we make a really important shift. We stop thinking about avoiding risk, and we start thinking like a professional about actively managing it. So let's open up the toolkit and see what they use. Okay, the first tool is one you've probably heard of, hedging. And this insurance analogy on the slide, it's perfect. Think about it. You don't buy car insurance because you're hoping to get in a crash. Of course not. You buy it to protect yourself from a total financial disaster if a crash happens. Well, hedging is the exact same thing. It's not about making money. It's a defensive move to protect your capital when things go sideways. So how does this actually work? A really common strategy is called a protective put. Let's just break it down nice and simple. Step 1, you own a stock, and you're getting a little worried about it. Step 2, you buy something called a put option. Just think of this as a contract that gives you the right, but not the requirement, to sell your stock at a specific price. That's your floor. Step 3, if the stock tanks and falls below that floor price, your option kicks in and you get to sell at that higher protected price. Bam! You've just capped your downside, you've built yourself a safety net. But here's the thing about hedging. It's reactive. It's a defense you play when you're already in the game. A truly professional process, though, is also proactive. It starts way before you even click the buy button. And that's where fundamental analysis comes in. This is the real detective work of digging into a company's financial health to see if it's a solid business that's worth owning in the first place. And the best part is, you don't have to be some Wall Street guru to do this anymore. Technology today can scan a company's financials for you in seconds, checking for stuff like earnings, revenue growth, and debt levels. The source material had this brilliant analogy for it. Think of it like a green thumb score for a company's financial health. It's a super quick way to see if a business is strong and growing, or if it's fragile and kind of wilting. You know, like a blockbuster video. Of course, no matter how much homework you do, you can't know everything. You're gonna miss things. And that's what makes this quote so incredibly powerful. Diversification is not some magic wand that makes risk disappear. It's an act of humility. It's a protection against the one thing that is absolutely 100% guaranteed in investing, the fact that you will, at some point, be wrong. And all of this leads us to our final and honestly the most important part of this whole conversation. We've talked about market risks, company risks, all the tools to manage them. But the ultimate defense, the true foundation of risk management, is all about focusing on the very few things that are completely within your control. So here's the bottom line. It's this simple. You cannot control the market, you cannot predict the next crash, and you cannot eliminate risk from the world. It's impossible. But what you can control, 100%, is your process, your actions, your decisions. And that right there is where your real power as an investor truly lies. So let's talk about your personal risk levers. First, and maybe biggest of all, is position sizing. You and you alone decide how much money to put into any single idea. It's maybe the most powerful risk tool there is. Second, your process. You decide if you're going to do the homework, if you're going to screen for quality, if you're going to use these protective strategies. And finally, the hardest one of all, your emotions. You have the power to act on a rational plan, or just react out of fear when things get scary, or FOMO when everyone's getting greedy. So I'll leave you with this one last question to think about. When you look at your own approach, your own investments, are you methodically building a resilient portfolio that's designed to manage risk for the long haul? Or are you just placing a series of disconnected bets and hoping for the best? The answer to that question is going to define your entire investing future. Thanks for joining me.